Hello everyone. So now let's go and talk about more broader things in financial industry, and this is growth or development of passive versus active investing industry. Well, why I'm asking you this or showing you this video for that matter, because while I was filming previously a video about hedge funds and hedge fund future, I told you that this industry has been extremely saturated and there are few big players which having institutional money and they are able to live out of that institutional money. But it's not in the 70s or in the 80s where you could just pay high returns and attract lots of money because you are cool. Now in today's world, the institutional investors require strict mandate and strict performance metrics. But what about passive and active investing? Because this has been also the backbone of financial industry for decades. Like someone makes a mutual fund for general public, asks 1 or 2% in fees, and then they are making stock portfolios. Well, in the last years, this is of course not new phenomenon because index funds there are here for decades. But in I would say 10 years, when internet and globalization became more apparent, costs decreased because technology allowed us to invest from our smartphones or whatever. So we had ease and access to markets, and that decreased costs and that decreased profitability of active managing industry because everyone was available to do the same thing. So naturally passive investing started to make more sense because actually it has performed relatively well. So for instance, there is the Bloomberg article which is effectively saying that, I wouldn't go into detail, but here's the thing: passive vehicles lead in the 11.6 trillion United States domestic equity fund market, and it will likely expand. So passive overtook active around August 2018, so years before this, and its market share stands about 54%, driven largely by growth of funds tracking S&P 500, obviously, and the total United States stock and other broad United States indices. So yes, and that's the thing. It still costs relatively less compared to stock market, but still it is growing, and you could see that. You could see the chart here. Now it's 53.8, and it will go to higher things. And this is what I'm saying here. What I'm saying here is that passive industry makes sense. Passive investing for conservative investors makes sense in the way that if you have to keep your money for safe and steady returns, it's better to do that with the least possible costs with highest probability of making money. And for active managers trying to beat stocks, this is extremely difficult to do that because you have to make strategies which is vastly better than passive ones, which statistically is not true, and it has to be done with costs which is equals to passive ETFs, which is almost impossible. So unless someone is making 10% more than general stock indices and has fee that justifies that, you are better off with ETFs and passive investing. I have always tell that if you want to invest yourself in stocks, you have to find angles. You have to find very flexible and unorthodox way how to invest. That's how you could beat general market with significant advantage, but also that would require higher risks. So here's the thing, and that's simply reflecting also an industry I just told you about. But what in practice that means? In practice that means you have more ETFs where you should invest with lower costs, and you have possibilities to do more things that you had ever done before. And also this is also what other article I just found randomly because I don't want to search them. I don't want to promote some other works because that's not mine. So that's saying simply yes that it's January 25th 2023, so not that old article. For United States wealth management firms, the decade-long period of relatively easy growth funded by favorable market conditions are over. That means market conditions and fees in general. So what they have to do something very cheap and affordable to everyone. This is ETFs. But here's the tricky thing. Even though this everything is true and you don't have to invest in mutual funds or stock hedge funds unless they're unbelievably good, which is extremely difficult to do that if you are very large, so the problem only gets larger. What you should do instead is to look at many ETFs which offers many things. But here's the question: what to do if you have like 500 ETFs which are reflecting every strategy you can imagine, like dividend investing stocks, value stocks, index funds, which index funds to invest, which dividends funds to invest, how to balance that portfolio, and what to do and when to do. Like, this question actually couldn't be answered in simple ways. And what I'm saying here is this is how I believe wealth management industry will develop. It will go from like all these well-known mutual funds which was managed for decades by something like Fidelity and Vanguard and things like that, and they themselves will transform to ETF passive funds, and someone has to be able to explain those passive ETF funds to general people. And I would say it will go to some boutique, more smaller scale, individually tailored advisory or consulting services, and they could help you, they would give you the idea how to work, how to manage those investments, and that would actually bring you some money, because in traditional way high costing mutual funds will just give fees to managers. But if someone actually goes individually and helps, which is not related to that issuer or to that company, that's more evident benefit, because if I'm working for, like, I don't know, Fidelity, I will push someone Fidelity products and will make fat fee out of that. But if I'm neutral, I don't care which broker or financial services you have, my interest is to bring best possible service which will generate best return for investors or clients, so there is no conflict of interest there. So I believe this is how it looks, that in the 10 years, like, there will be only lists of extremely low cost index funds, and there will be capable boutique companies, advisories and consultants who will advise people how to better allocate these funds. So this is probably where management is going. And what about AI? Well, the thing of AI is that it actually doesn't answer to any important questions about investing, but we will get to that later. But I'm just saying here, AI has absolutely no advantages or edges to absolute majority of investors, unless you're coding something or bringing something for technical work. And AI just could simply help you with that. It could help you to find data or operate with data or make some coding languages, or I don't know, make automatic email texts. This is good for AI, but for investing decisions or for trading decisions, it has no edge as of now. But as I told you, we'll get to that later. But for now, I would say mutual fund industry and traditional wealth management industry has huge problems, because ETFs are kicking in and they will be here to stay. But someone who knows ETFs and could explain those ETFs to regular people, that has huge advantage for them. So stay tuned, make sure you're following me, and till my next video.